The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody. This is Nicole from Insurance Agency Marketing, and today we're going to be going over the 3 annuity long-term care options offered by One America. We're going to be joined by Jim Dupree from One America to explore these products. We do have some housekeeping items that we do have to go through, though, as you all know. I'll try to make it quick. First thing we're going to talk about is IAMS Business Builders that we do offer, our referred producer program. So if you refer a producer over to IAMS and the producer contracts, you will receive a $50 cash bonus. The first piece of business your referral does, you'll get a $100 cash bonus. And then going forward, we're going to pay you a 20 basis point perk on their business. It's not override. It does not affect their commission whatsoever. It's just IAMS' way of thanking you. Just as your business is built on referrals, so is ours. The other thing that we need to touch base on is our marketing reimbursement program, which is IAMS' way of helping you cover the cost of doing business. So for every $100,000 of indexed annuity premium, you will get $100 in your marketing reimbursement account. $20,000 of life target premium gets you $200 in your marketing reimbursement account, as well as any $100,000 of single premium life will get you $200 in your marketing reimbursement account. Those dollars have very few restrictions on them. They are designed to help you cover your costs of conducting business. Next thing we're going to talk about is our new producer builder program that we do offer. These are for agents who have recently contracted with IAMS. These levels are for your first 180 days or 6 months of being contracted through us. If you write $100,000 in premium, you can choose one of the 3 options that you do see on your screen. One of which being a free producer website that we will build and maintain for you over a 2-year period, a $750 cash bonus, or the newest iPad. The $300,000 level gets you a Social Security program, and we have changed, but we will be generating clients to attend your workshop. We may not be doing it through mailing. We may be doing it through Facebook advertising, or $2,000 in your marketing reimbursement account, or a $1,500 Visa gift card. If you should be so ambitious to hit a $500,000 in 6 months, as you can see, you do have those 3 options available to you. This is the most important thing I feel that IAMS has to offer, and that is our back office support. The goal here at IAMS is to be your back office. We want to take all that work off your plate so that you can spend your day out selling. We have business building tools and resources on our website. We offer case design assistance, so you call in, you've got a case. Whether it's a life or annuity case, an annuity or life marketer will get you help you with the case design, get you all your applications, brochures, illustrations. If it's annuities, product training links. We have forms at your fingertips on our website. Our new business team, once you get that piece of business sent in, will scrub your application, let you know if anything needs changed, then get it sent up to the carrier. And most importantly, follow up on it every 2 to 3 business days to make sure your business is being processed in a timely manner. We have top sales expertise and coaching through some of our top agents, and we do have a paperless contracting system so that once you have completed our data packet, Adding a carrier is as simple as shooting your marketer an email or giving them a quick call to let them know what carrier you would like to be appointed with. Our creative marketing department is also at your fingertips for any marketing materials you might need. They will design your newsletters, your business cards, brochures, any online marketing you might want to do, social media, and website design. Anything that you need in as far as marketing goes, our creative marketing team is there to help you. Our website is an excellent wealth of knowledge. You can run your quotes on it, term quotes. You can pull MIGA rates. You can run rider comparisons. It has our current annuity news on it, industry links. You can access forms through the website. And under the support tab, as you can see right there, we have our sales resource library, which is a wealth of information and sales ideas for you. The Retirement Analyzer is a software program that is very simple to use, and it is designed to help your clients analyze where they are and what they need to do to achieve their retirement goals. Marcus Solar does work with our agents on this, so if you would like more information on the Retirement Analyzer, please do not hesitate to reach out to Marcus. He would be happy to walk you through the Retirement Analyzer software. IAMS Wealth Management is not new anymore, but we do have a IRA within, an RIA within IAMS. Requires a Series 65 CFP or CFHC, and they can help you with all of your assets under management. Our Life and Annuity Training Academies. This is another big thing that IAMS does offer agents. It's an excellent opportunity if you're active in the life and annuity markets. It's a 2.5-day marketing summit. We bring in our top producers. They go over the marketing strategies that they have used over their course of their careers to get from the bottom to the top of the industry. Just an excellent, all expense paid opportunity for agents who are active in the life and annuity markets. And with all of that being said, I am going to hand it over to Jim, and he is going to go over all of the One America annuity long-term care options that they do have available.
All right. Show my screen here. Just out of curiosity, can you tell me if you're seeing my screen, my home screen? Is that working?
I can see now viewing your screen, but it's your big screen.
Yeah, that's okay. That's my desktop.
Going.
Yep. So there
we
go.
go.
All right. I'll get that out of the way here. All right. As she said, my name is Jim Dupier. I'm the internal supervisor here on the sales desk with One America. Appreciate you all having the time to bring me on here for this. Without you all of you, I don't have a job. So you're a big impact in our world as well. So thank you. Today we're just going to discuss the annuity portion of our business. We do have a life side, but again, we're just going to exclusively talk about the annuity side of it. If you have any questions afterwards, feel free to email me, or if you want to copy the slides, my email address is Jim, and then my last name Dupier, DUPIRE.I is in internet, S is in Sam, P is in Paul, at oneamerica.com. So let's go ahead and kick this off here, if I can get this working. All right. Let's see here. There we go. make a quick change. All right, so just for compliance purposes, to give them their moment in the sun here, this is the knockouts for them, give them a little chance to shine. And let's move forward. So before we jump into the solutions themselves, I want to show you the opportunities that are out there. These aren't our numbers. These are numbers from LIMRA and Gallup here in just a moment. But you can see here, there's $1.97 trillion in deferred annuities that have been out there since the 2015 survey. Almost $92 billion in non-qualified assets. That is a lot of opportunity that's out there that I think people are missing for our solutions. And most of them are purchased right around that age of 51, which is in that sweet spot of when people start planning for, their retirement a little more, get more into the details and the weeds of that, and also looking into the risks of long-term care. So everything kind of falls in line with where our solution fits with this. Something we discovered with the Gallup survey when it came back is that 70% of people intend to use this for an emergency, for the catastrophic nursing home, long-term care. They've earmarked it for those purposes. And jumping back here, 73%, $92 billion in non-qualified, that's a lot of money. Even if it's 50%, that is a lot of money out there on the table that people are looking to repurpose just for the very thing we're looking at doing here today, or you're looking to sell, and then also up to almost $2 trillion. That's a great opportunity for the agents, a great solution for the clients that you'll see here in just a moment. But it's just really a staggering number that I was surprised when I saw this. Our annuities are very similar to what you see out there in normal annuities. It's tax deferred. You can grow the cash value, death benefit, bypasses, probate. You have the option to annuitize. Personally, I would not look at our solution as something to annuitize. This is for a long-term care income, not just for your regular income. There are other annuities out there that you're fully aware of. They're designed just for normal income purposes. This is for long-term care income. And that's where I would focus at. If you're looking for just something that's just a growth vehicle, we're not a growth vehicle, but we do have growth. But again, this is a long-term care focused solution that I think you'll see the power of the leveraging and what we do with our design that will make sense here in just a moment. Where our solutions come into play at, and really get the leverage is the Pension Protection Act. I don't know if you're all aware of how that works. A lot of times you'll hear us refer to it as the PPA. But in a normal annuity, in this situation here, let's say you put $50,000 in over time, it grew, you had a $75,000 gain, $125 cash value. As that pays out in their current annuity, that's going to come out taxable gains first. And so they're going to get hit with the taxes as they pull it out, even if it's earmarked for long-term care. With our solutions, the Pension Protection Act kicks in. So we 1035 the money over, everything comes out tax-free for long-term care. Now, what the Pension Protection Act does, it does draw down the basis first. The government's in this for the clients, not their beneficiaries. So it comes out gains or basis first. Government's hoping the client's not going to use it all. Maybe they can tax the beneficiaries, but all those gains will come out tax-free as well if they need it for long-term care, because the government doesn't want to have to pay for it. So they're giving a break basically to the owners of these policies to help avoid them going on Medicaid or things of nature and using them as a resource to pay for their long-term care. So we have multiple solutions. The first one is Annuity Care I. It's a deferred annuity. It is a fixed annuity. It goes up to age 85. So one of the beautiful things about this is most people think that after age 80, they don't have a solution. So in our design, we go up to age 85 again, and that opens the door for a lot of people. Base policy only, you can be single or joint. With the base only, it is a simple underwriting process. They don't only do a phone call. It is strictly, we look at the MIB report, we look at the application, and then we make the decision from there. As you'll see here, we take non-qualified is the biggest thing we see happening on this, where the funds come from, but we do take qualified assets. There are some limitations around qualified assets. For example, California doesn't allow us to use qualified assets in any of our annuities. And we can only take 1/3 of their qualified assets if that's what they want to use. And the reason being is we don't see this as RMD friendly. We want them to go to their other annuities, their other IRAs to meet the RMD requirements. We have set this money aside for long-term care. If we have to take it out, meet R&D requirements, we're kind of going against the grain of why we bought it. It doesn't make sense to drain something we're trying to save for a long-term care event. So that's why the 1/3 rule is out there. But with all of our solutions, where it's life or annuity, we have two components. We have the base policy, which in this instance it's the annuity, and then we have the optional rider. The rider is like a traditional policy on the back end of the annuity. So think of it more of a traditional LTC policy. The value is long-term care. There's not a cash value or death value to the rider. It's pure LTC insurance. Now it's guaranteed not to change in cost, and we can't cancel it. So we'll never get a raise or an increase like you see in some of the traditional policies out there where I had one the other day, the client got a 35% raise, increase in cost. We don't do that. Now they can annual pay the rider. They can single pay the rider. Again, non-cancelable, inflation option. The additional rider can, in Annuity Care I, can be an additional 36 months, so we mirror the base policy, or we can do a lifetime. So an 85-year-old who is fairly healthy could get a lifetime benefit. They could do a joint policy, again, cover both of them. I would recommend paying the rider on an annual basis because they're probably closer to using it. All of our riders have a waiver of premium built into them. And the way it's triggered, when they go on claim and get to the rider, so they have to exhaust the base policy, but whenever that rider is paying a claim for either insured, we're waiving the rider premium. So someone who is 85, I would probably look at annual paying the rider rather than single paying it. And it just makes a little more financial sense. But again, we can go up to lifetime on this. So here's an example I'm going to show you of an 81-year-old female moving over funds. In this scenario here, 125 comes in. The base policy is designed to pay out over 36 months. Now, with that being said, if her monthly benefit, say, is $2,000 and she's only needing $1,000, it will last longer. But if she's pulling the full amount, she will exhaust the annuity in 36 months. In this scenario here, we are showing the rider being paid as a single premium. So out at 125, 102.5 is going into the annuity, 22.5 is paying for the rider. This would give her $36,000 per year tax-free for life as a reimbursement for long-term care. And our policies are reimbursement. They're not indemnity. We cannot offer indemnity and offer lifetime at the same time. It would that type of design would not work. And again, if it does base-only annuity, as you can see down at the bottom, there's no telephone interview. Anytime you add a rider onto it, it does require a telephone interview. But that is the most underwriting they'll have to do. So Annuity Care II is our second option. It is also a fixed annuity. The only difference this here is the rider options. The riders are built in and paid internally by the annuity. As you can see right here, monthly LTC charges come out. These are age banded. So somebody who is 75 years old could not get a 108-month rider. The max they could get would be 36. So it is age banded, but it's all paid internally. And if it's a single, it's 24 months. Joint policy, the base lasts for 30. And then you can tack on, you choose the rider that fits. So we can 2.5 times, 4 times, or 5.5 times the total pool of money for long-term care. That does have a max age of 80. And the reason being is a big chunk of it is because we're trying to control the cost here. Again, once you go over 80, those costs jump quite a bit. Let me jump ahead. So here's another example of Annuity Care II and how that would work for a 70-year-old female. So again, $100,000 goes in. All the money goes into the base policy on this, and again, the monthly charge comes out of the annuity. So now it just comes down to which one best fits the client's situation. Based on the resources and the type of coverage they're looking to have, you can do a 36-month rider, generates an extra $150,000 pool of money for the client, so they have a total of a $250,000 pool. So again, 2.5 times what they originally put in for long-term care. 72 months, as you can see the math, how it's going to work out here, that's going to jump to $400,000 in long-term care pool for the client. And if we go to 108 month, 450, again the math, we've got over $500,000 pool of money for the client. Now, let's say the client doesn't go on claim, they're into their 30th month, the annuity is gone. There's nothing left cash to leave to your beneficiaries. However, again, we've paid out a lot more money, depends on how long that claim lasts, and we've saved all their other assets because now we are, they still have extra $300,000 from One America to work through before the pool money would run out. Now, the index annuity is really one of my favorites. I'll show you in a moment how a multiplier works, but it gives me that, hey, look, I get a little bit chance to grow the money. There's potential to, again, if you don't need it for several years, to get a higher benefit off the base policy. It is a fixed index annuity. For a single person, 24 months, the base policy would pay out over, or for a joint, it's 30 months. Something to point out on all these, say it is joint, they both call and claim at the same time. Not usually it works, can happen. It would exhaust that pool of money twice as fast because it reduces dollar for dollar. If your monthly benefit is $4,000, they can both get $4,000, but that annuity is going to shrink twice as fast because now we get $8,000 pulling off an annuity. Once annuity is exhausted, that's when you move to the rider's benefit. And again, that rider's is very similar to what a traditional is. It's just pure LTC benefit. With the index, you have the option, again, to double it, triple it, or lifetime rider on this. It really just depends on, again, their needs and what fits their finances. On this, we also go to age 85. The withdrawals for it are also Pension Protection Act. They come out tax-free for reimbursement. On this, again, qualified money, if you put that in one of these, the qualified money is always taxable. The rider is tax-free, but the money coming from the annuity on qualified, that's still qualified money. It doesn't change. Uncle Sam does not give any breaks that I'm aware of. They're going to pay taxes on the withdrawal from the qualified account. The reimbursement from the rider when they get to it would be a tax-free benefit. And again, basic only, no telephone interviews. I probably see 2 or 3 a month where I have an 82, 83-year-old who has a sizable annuity. The way their finances are set up, they are trying to figure out, how can I position this money, because I have a large estate, to get a tax-free benefit? How do I, avoid a big tax application on my estate in case I have this happen? They'll do base policy only. They know the money's going to come out tax-free for care if they need it. If not, their family's going to inherit it just like they were before. So nothing changes. Nothing changes there. So we do have some different options in the strategies they can choose from in the index. So we do have the point-to-point strategy. We have point-to-point caps and pars. It's off the S&P 500. So you can see just some examples here of how that works, what they'd be credited in these different situations. But again, these are just hypotheticals. So they're never going to lose money. As you can see here, market went down, S&P 500 went down 5%. They didn't lose anything. Went up 2, they got 2, went up 20, cap is 4. Pretty simple math on that, how that works. Same thing here on the point-to-point participation rate. It's a percentage of percentage at the end of the day. Is the best way I explain it. You can see how that would be credited out. But again, we have 5 options. We have a point-to-point cap, point-to-point par, monthly participation cap and par, and then we also have a fixed account. So they're all options. Every year they'll change that. They'll get a letter before their anniversary saying, do you want to adjust anything or not? It's really their call on how they want to move forward. What I really like about the index, and this is where if some of you ever sold income riders, think about an LTC income rider, so to speak. It's an internally how we do crediting. So in our solutions, you're going to see on a ledger page, hey, here's the account value, but here's my long-term care value, and that's what we base your monthly benefit off of. And this is what the multiplier looks like. Let's say your client is, say, 60 years old, and they don't need this for 15 years. Okay, we're going to look at these 2 columns. We're going to take their account value at the end of 15 years, multiply it times 1.15, and say, what's that number look like? Let's say we put in 125, we could be very well over 150 if the account has performed on that. And we're going to base their monthly benefit off of that stepped up number. So not just the growth, but the stepped up number from the value that is obtained plus the multiplier. This just say the account didn't do anything. The S&P 500 crashed every year. You never saw a nickel of growth. We're going to take, in the year 15, we're going to take the 125 times 1.35 and base the monthly benefit off that number. So whichever one's higher in that scenario, be 168,000. You put in 125, your reimbursement and income basically for long-term care is going to be based off $168,000. So there's no internal BIPs in our product being charged to anybody. We have this multiplier. So when you look at index annuities out there and we look at the rates, where's rate at? Yeah, we're going to be a little bit lower than just your standard index annuities out there, but no internal BIPs being charged. The money's coming out tax-free, and you have this multiplier. When you build those things into, hey, look, what will this give me? Those other indexes have to perform at a very, very high rate to keep up with what we can do here. Now, this is just on the base policy. This is just on the annuity. The rider is a separate contract. It's a separate piece. The rider will be the monthly benefit of whatever you bought day one, unless you add inflation. Normally, on someone younger, I will look at probably like a 2% inflation, so it keeps up or tries to keep pace with what's happening on the annuity, so they don't feel any adjustment. For somebody older, I don't look at a inflation on the rider because the odds of them needing it sooner and the cost don't usually make sense. But again, somebody younger, I would look at inflation on the rider. And again, that rider can be paid annual paid. It can be single paid. One thing to point out about our riders, if they follow the 7702B code, if they're going to pay those annually, if your client has an HSA account, you can use HSA dollars towards the purchase of that rider. It happens in our life policies as well. That rider falls underneath that IRS code. The IRS has a grid on what those amounts are based upon their age. And it's potential write-off. It's harder to write things off nowadays because of the itemization and things of that nature, but there are amounts they can write off. And again, the IRS has a grid on that. So annual paying sometimes plays the advantage of the client in those situations. So the index annuity here, just another example, money coming in 125, and the scenario here, we're going to split it again, single pay both the base and the rider. This is showing the day one benefit. If they want to claim the month after they got it, they would actually be able to get $42,000 per year tax-free for life. Now, what's not showing you is, hey, look, 10 years from now, 15 from now, what does that look like because of the growth and because of that multiplier? That base policy is going to go up. Even if there's no earnings, because of that multiplier we have, it's going to continue to ratchet up until they go and claim, and that's where it's going to lock in at. Now, that's the end of the webinar piece. The one thing I want to point out on our annuities, there's 4 times really when I look at using the annuities. One is a tax situation. You have a client who has a sizable gain in a non-qualified annuity. They don't want to pay taxes. So you can't take it directly to a life policy. And even the solution we have, they're going to pay taxes on it. So they want to avoid that. For estate purposes, for other tax purposes, they want to avoid it. That's a great time to use the annuity. 2 is health. So you get someone whose health is questionable, and they don't think they would qualify for a life policy. You don't want to put them through underwriting to get a turn down out there. Annuity is a great way to go. It's less underwriting. It is underwritten, but it's not near as strict. The only way we rate an annuity case is to say 1, decline it, or 2, maybe limit the rider options because of their health. But we do see less because we don't do the traditional underwriting. We don't do the medical records. 3 is age. You got somebody over the age of 80. I have 2 solutions that go up to age 85. Again, that's a market that a lot of people don't have a solution for when it comes to long-term care. The 4th is maybe you got somebody who doesn't want to do underwriting. Hey, look, you know what? I don't want to do traditional underwriting. Maybe you've already sold some life policies, something's happening. They don't want to go down that road. This is a way to avoid that and move forward. So I don't know if there's a way for questions to be, if there are questions or if there's any questions out there.
We don't have any questions, and I will be following up with all of you after the webinar. So if you do have questions, write them down. And if I do not have the answer for you, I will get with Jim and get that answer for you. But no, we don't have any questions, okay, Jim. So I do truly appreciate you joining us on this webinar today. This is a great option for clients looking for long-term care benefits. Thanks for joining us, Jim. And we will hopefully do another one of these soon.
Hey, just let me know when. We can definitely be a part of it, myself or Roger.
Okay, thanks so much.
All right. Thank you.
Thank you.
Bye.
Bye-bye. All right, everyone. As I said, I will be following up with you after the webinar. So if you do have any questions, write them down and I will get those answered for you. Thanks for joining us. Thanks for taking time out of your day, and I will talk to you soon.